Welcome to the channel. This video is going to tell you absolutely everything you need to know when first getting into the stock market. And I mean everything. The grind to joining the stock market is not for the get-rich-quick scheme. It's a long mixture of trial and error and studying technical analysis. With that being said, grab your popcorn, subscribe and get to learning. First, let's start off with a basic list of vocabulary related to the stock market. Bull market, a market characterized by rising prices. Bear market, a market characterized by falling prices. Market index, a statistical measure of the state of the stock market, often represented by a mathematical computation of the prices of a selection of stocks. Stock, a type of security that represents ownership in a corporation and entitles the holder to part of the corporation's profits. Bond, a type of debt security in which an investor loans money to an entity, typically corporate or governmental, in exchange for interest and the return of principal at a later date. Mutual fund, an investment vehicle that pools together the money of many investors and uses that money to buy a diversified portfolio of stocks, bonds, or other securities. Dividend, a distribution of a portion of a company's profits to shareholders. Earnings per share, EPS, a company's profit divided by the number of its outstanding shares of stock. Initial public offering, IPO, the first sale of stock by a private company to the public. Short selling, the practice of selling securities that the seller does not own in the hope of being able to buy them back at a lower price later. Trade, the buying and selling of securities. Trading volume, the number of shares or contracts traded in a particular stock or market over a specific period of time. Broker, an individual or firm that charges a fee or commission for executing buy and sell orders for a particular security. Analyst, a professional who evaluates securities and provides recommendations to buyers or sellers. Portfolio, a collection of investments held by an individual or organization. An option is a financial derivative that gives the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. There are two types of options: call options and put options. A call option gives the holder the right to purchase the underlying asset at a specified price, known as the strike price, on or before the expiration date. A put option gives the holder the right to sell the underlying asset at the strike price on or before the expiration date. Options can be traded on various underlying assets, including stocks, currencies, commodities, and indexes. They are often used as a way to hedge risk, generate income, and speculate on the direction of asset prices. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. Technical analysts do not attempt to measure a security's intrinsic value, but instead use charts and other tools to identify patterns that can suggest future activity. Some common techniques used in technical analysis include trend analysis. This involves looking at the overall direction in which a security's price has been moving. Support and resistance. These are levels at which a security's price has had difficulty breaking through in the past. Moving averages. These are used to smooth out price fluctuations and help identify trends. Chart patterns. Technical analysts look for certain patterns in the price charts of securities, such as head and shoulders or flags and pennants, which can indicate a change in trend. Technical analysis can be used on any security with historical trading data, such as stocks, commodities, and currencies. It is often used in conjunction with fundamental analysis, which looks at a company's financials and other fundamental factors to determine its value. Studying earnings reports and dividends can be an important part of fundamental analysis, which is a method of evaluating the intrinsic value of a security by examining factors such as a company's financial statements, management, and competitive advantage. Earnings reports. Companies are required to release earnings reports on a regular basis, usually every quarter. These reports provide information on a company's revenue, expenses, and profits, or losses, for the period covered by the report. Investors and analysts study earnings reports to get a sense of a company's financial health and performance. Dividends. A dividend is a distribution of a portion of a company's profits to its shareholders. Companies may choose to pay dividends for a variety of reasons, such as to reward shareholders or to distribute excess cash. Dividends can be paid in the form of cash, stock, or other property. Investors may be interested in dividends because they provide a source of income from their investment in the company. It is important to note that companies are not required to pay dividends and may choose to reinvest their profits instead. Some studies have suggested that the majority of day traders do not make a profit, and that a small percentage of day traders are responsible for the majority of the profits in the market. However, it is important to note that past performance is not necessarily indicative of future results, and individual results may vary. There are many factors that can influence a day trader's success, including the trader's level of experience, risk tolerance, financial resources, and the strategies and tools they use. Day traders should be aware of the risks and be prepared to handle the volatility and fast pace of the market. It is important for day traders to have a solid understanding of financial markets and to develop a disciplined and well-planned approach to trading. Risk management is an important aspect of investing in the stock market, as it involves identifying, assessing, and controlling threats to an investment's value. Effective risk management can help investors minimize losses and maximize returns. There are several steps that investors can take to manage risk in the stock market. Diversification. This involves investing in a range of different assets, such as stocks, bonds, and cash, in order to spread risk. Asset allocation. This involves dividing an investment portfolio among different asset classes, such as stocks, bonds, and cash, in a way that is appropriate for the investor's risk tolerance and financial goals. Risk assessment. This involves identifying the risks associated with an investment, such as market risk, credit risk, and liquidity risk. Risk control. This involves taking steps to minimize or mitigate identified risks, such as using stop-loss orders or hedging. Risk monitoring. This involves regularly reviewing and evaluating the risks in an investment portfolio and making adjustments as needed. It is important for investors to understand that all investments carry some level of risk, and no risk management strategy can guarantee a profit or protect against loss. Paper trading, also known as simulated trading, is a way to practice buying and selling securities without using real money. Paper trading allows investors to test out investment strategies and familiarize themselves with market conditions and trading platforms without the risk of losing actual funds. Paper trading can be a useful tool for new investors who want to learn about the stock market and for experienced investors who want to test out new strategies or practice their skills. Many online brokerage firms and trading platforms offer paper trading services, which allow investors to place simulated trades using virtual money. It is important to note that paper trading does not replicate all of the risks and challenges of real-world trading. For example, paper trades do not incur real commissions or taxes, and market conditions may not be the same as they are in the real market. As such, paper trading should not be relied upon as a sole source of information for making investment decisions. Pattern recognition is a technique used in technical analysis to identify repeating patterns in the price and volume of securities. Technical analysts believe that these patterns can be used to predict future price movements and to make trading decisions. There are many different types of patterns that technical analysts look for, including trend lines. These are lines drawn on a chart to show the overall direction in which a security's price has been moving. Support and resistance. These are levels at which a security's price has had difficulty breaking through in the past. Chart patterns. Technical analysts look for certain patterns in the price charts of securities, such as head and shoulders or flags and pennants, which can indicate a change in trend. Candlestick patterns. These are patterns formed by the candlesticks on a price chart, which can indicate buying or selling pressure. It is important to note that pattern recognition is not a precise science and that past performance is not necessarily indicative of future results. Technical analysts use a variety of tools and techniques in combination with pattern recognition to make trading decisions. Candlestick charts are a type of financial chart used to display the high, low, open, and close prices of a security over a given time period. Candlestick charts are often used in technical analysis to help identify trends and potential trading opportunities. Each candlestick on a chart represents a specific time period, such as 1 day or 1 hour. The body of the candlestick is shaded in and represents the range between the open and close prices for the period. The thin lines extending from the top and bottom of the body, known as the wicks, represent the high and low prices for the period. Candlestick patterns can be used to identify potential buying or selling opportunities. For example, a bullish pattern, such as a hammer or a morning star, may indicate that the security is likely to rise in price, while a bearish pattern, such as a hanging man or an evening star, may indicate that the price is likely to fall. It is important to note that candlestick patterns should be used in conjunction with other technical analysis tools and should not be relied upon as a sole source of information for making investment decisions. Indicators are statistical measurements that technical analysts use to analyze financial markets and make trading decisions. There are many different types of indicators, each of which can provide different insights into market conditions. Some common types of indicators include trend indicators. These indicators, such as moving averages and trend lines, are used to identify the overall direction of a security's price trend. Momentum indicators. These indicators, such as the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD, are used to measure the strength of a trend. Volatility indicators. These indicators, such as the Average True Range, ATR, and the Bollinger Bands, are used to measure the level of price fluctuations. Oscillators. These indicators, such as the stochastic oscillator and the Williams percenter, are used to identify overbought and oversold conditions. Indicators are typically plotted on a chart along with the security's price, and can be used to generate buy and sell signals. It is important to note that indicators should be used in conjunction with other technical analysis tools and should not be relied upon as a sole source of information for making investment decisions. Thanks for watching our video on everything you need to know to start trading the stock market. We hope that you found the information useful and that you feel more confident about taking your first steps into the world of trading. Remember to always do your research and to manage your risk carefully. And if you have any questions or need more information, don't hesitate to reach out to us. We'll see you in the next video.